Good morning, everybody. I'm going to review this week's articles and take a little question and answer, as well as introduce the two topics for the next two Fridays, which are going to be marijuana ETFs and the greater cannabis industry, and then cryptocurrency, which will kick off a series of presentations I'm going to do on cryptocurrency. And just in case you've missed it, I did post a link to CoinBase. I will put out a little intro article this weekend on the cryptocurrencies as I'm seeing them, why you want to get involved, what you need to study. And the link that I have to CoinBase actually makes you eligible to do some what's called learn and earn, meaning that just by reviewing their 1-minute videos, 2-minute videos on different types of cryptocurrency and how things work, they'll actually give you some for free. And the reason they do that is I believe just to get people involved. It makes you look at it. And as these cryptocurrencies develop, as the end uses develop, as the networks expand, there will be a handful of winners. Maybe you'll get lucky and have a little bit of a winner. But I do still say that 99% of cryptocurrencies are going to lose 99%. So keep that in mind. There's going to be a dozen or 2 dozen that survive out of thousands, and that has to do with how much development is going into them. So networks that don't have any development, networks that are designed to create something to replace fiat money, dollar, the euro, the yen, those are all going to get wiped into oblivion. It is very easy to regulate those sorts of things out of existence. However, the networks and cryptocurrencies that have end uses, for example, Ethereum, to handle anything that requires a currency transaction or a contract or some sort of permission, basically everything in the economy, those will have value down the road. But anybody who thinks that we're going to replace sovereign currencies with something like Bitcoin is out of their minds. It will never happen. Bitcoin itself will survive as a store of value, but you're not going to buy your pizza with it. So I encourage you to catch those webinars as I put them out. And then, like I said, I'll put an article out this weekend, kind of the introduction to cryptocurrencies to start the conversation that I sort of started a year ago when I told everybody to buy Bitcoin after the coronavirus crash. Had you bought it under 10,000 or under 15,000 or under 20,000, as I recommended, 7, 8, 9, 10 times, you'd be up quite a bit. Now, there's going to be another crypto crash, probably because the dollar is strengthening and regulation is coming. So let's talk about the dollar and inflation and everything else that's going on right now. I talked about that in yesterday's article on Seeking Alpha, so I hope you've gotten to read it. I've covered this material a number of times, and I just framed it here for Seeking Alpha. They require unique content. That's why it's only here. But I think that this is an important topic to wrap your head around. I think people who believe that inflation is going to stay higher for longer are completely wrong, and there's a number of reasons why. And it comes from figuring out where does inflation come from. And inflation, unfortunately, it looks very small on this screen. Pop that up for you. Inflation is coming from just a handful of places. So if you take a look at the year over year, energy is the giant component to inflation, followed by transportation. And by transportation, it's a pretty big field here that they're covering, a pretty wide range they're covering. Cars have gotten more expensive because of the shortage of semiconductors, but also because of a shortage of drivers. So you have companies like UPS or FedEx or even the Postal Service having to raise rates. So everything related to transportation has gone up from a myriad of factors, from supply chain to labor shortage and from energy. And those are really about half of the increase in inflation. So if an inflation rate just got measured at 6%, right, 6.22%, and half of that is transportation and energy, you can imagine that probably the inflation number probably gets cut in half within about a year, just from transportation and energy flattening out, which they will. Why will they flatten out? Transportation always flattens out. I worked with the Teamsters for a number of years, first as a steward when I worked at UPS, but then I was involved with some of their financial benefits. And it goes in waves. This particular wave is severe, and it is a offset, an offshoot from the coronavirus adjustments, and the supply chains moving at the same time. Supply chains have been moving for the better part of a decade, really kicked into high gear after coronavirus, because when's a better time to move your supply chain than when everything's shut down? That process of moving supply chains is going to adjust over time. It's not just the fact that ships get stuck once in a while. That photo is by Planet Labs, by the way. Or that ports are full and have a shortage of workers. This picture is by Black Sky, by the way. It's that the resources and the labor that are helping move a supply chain closer to end consumers and to safer jurisdictions just takes time to get put in place. So over the next year or two, you're going to see a number of things. One of them is going to be that Intel has already started building their new fabs, but more importantly, they have increased capacity at their existing facilities all over the world. So when a behemoth like Intel says, hey, we're increasing capacity, or other companies that are out there saying that they're increasing capacity where they already operate, you can say, well, if semiconductors are one of the other big components that are driving inflation, because they are causing a lot of the inflation in transportation, along with labor problems, you ask yourself, okay, if we're going to have enough semiconductors in about 2 years, and the gap between what we need and what we're producing keeps shrinking between now and then, that's less and less and less and less pressure on inflation. So what I'm telling you is that probably we have either reached the peak in the inflation prints, or we're really close to reaching the peaks. I don't know if there's going to be one more energy surge into winter because people are going to pay whatever they have to pay to stay warm. I could see that happening. But from there on out, you probably have downward price pressure on inflation by March, maybe by February. And I would think that the CPI print in March is in the 4 range, a little above, a little below 4%. Then as you run into summer, maybe it stabilizes a bit during drive season and air conditioning season. Air conditioning seasons become as expensive as heating season. Drive season and air conditioning season seem to overlap, right? June, July, August, September. By next autumn, you probably have inflation prints in the 3s, maybe even the 2s. I don't think you get under 2% for a while, probably not till 2023 or 2024, maybe 2025 even. But you'll probably have inflation prints in the 2s by sometime in the first half of 2023. So a steady decline in inflation prints between now and then. One of the factors that you need to consider is the other article I wrote, and that is that the Fed and the Treasury are tightening up on the money supply. So if the Fed and the Treasury reduce liquidity, chasing assets and prices and services, goods and services, it's going to be less inflation because the dollar gets stronger. So as the dollar gets stronger, and I've showed you that chart a number of times, it bottomed, the dollar bottomed with the election of President Biden. This is something I told you would happen and has happened. Right, we've looked at the dollar chart a number of times. President Biden's elected, it double bottoms, and the dollar's been rising. The dollar's probably going to keep rising while the Fed is tapering and while the Treasury is issuing fewer treasuries. That process is going to last into the middle of next year sometime. But ultimately, as I've said over and over and over again, deflation is the boogeyman. I think there's a pretty good chance that the Federal Reserve doesn't finish tapering and getting QE down to 0. I think there's a pretty good chance that we don't see interest rates go up till the next administration. And why is that? Again, deflationary pressures are super deep and super long-term. Short-term inflationary pressures are merely a trade and an adjustment. And the adjustment that you need to be aware of, even though inflation is transitory because that measures a rate of change, most price levels, for all intents and purposes, will be permanent. So 50 years ago, when you were paying a dime for a loaf of bread, now it's $3, right? You never went back to the dime. That's just what's happening now. We're getting to a new plateau for lots of different things, including wages. And wages are incredibly sticky. So as wages go up, the odds of wages coming down, particularly in the face of retiring baby boomers and smaller generations behind the millennials, wage inflation, although it'll dissipate, the price levels of labor, what you earn, probably stay relatively high. And what do we know during periods of deflation? Those who are employed during periods of deflation do very, very well. Why? Because you have more purchasing power. So that $1,000 that you earn that week can buy more stuff. I say $1,000 because that's like exactly the average wage in America is $1,000 a week. Doesn't mean a lot of people earn $1,000 a week. There's a lot of people that earn $400 or $500, which is the dumbest thing ever. And that's getting pushed up, thank goodness. And then there's also, of course, people who earn millions of dollars a year. That pulls that average up. So really, the average person in America makes about $20 an hour, not 25, as 1,000 a week would imply. So if you actually have the average wage, and again, this would depend on your geography, you're making $20 an hour. So when they talk about raising the minimum wage to 15, I don't know that that's appropriate for everywhere in the country. However, in reality, it's already starting to play out. In Milwaukee, it is almost impossible to get anybody for under $15 an hour. And if you're a small business, you better be able to invest in the technology that you need and to be able to train people and offer them a competitive wage with the big companies who have a huge advantage because they are financed by cheap capital through the markets, bond and stock. So the little guy often has to go out and find angel investors or borrow money from small business administration or a bank to be able to catch up. And I don't have a lot of empathy for companies, little mom and pop places that never reinvested into their business. I really don't. I'm a small business guy. And if you're not investing in technology or whatever it is you need to keep up, that's kind of your own damn fault. And I'm a pretty liberal guy to say that. At the same time, the big guys have had the advantage of cheap capital through the markets. There's good and bad to that. The good is that if you are an investor and you're saving some of your money and investing in the stocks, you end up doing pretty well over time. And if you can avoid those 2 or 3 big drawdowns per decade and just have a scaling in method that doesn't rely on, oh my God, is this the bottom? Invest a little lower than you sold at gradually as it goes down. You're going to do pretty good because it'll go back up. Because we know that the Fed is probably just reloading their bazooka. And they'll be reloading now for the next year or so, maybe shorter if I'm right, that growth expectations may not keep up. And I think that growth expectations don't necessarily keep up more around the world than here. Supply chains are moving back to America because we're safer, we're more trustworthy. And Europe, they're moving to Europe too. But really, China is challenged to expand and grow anymore. And they've been a major growth engine for the global economy. But ultimately, between China and India and everywhere in between in that part of the world, there's a lot of freaking people. So they'll grow, the populations will push them to do it. And ultimately, China's not the place I want to be most invested in, but it's India. Mark Mobius has about half of his money invested in India now. We talked about India, about 2 years ago? And for those of you who did buy those 2 funds, you're up pretty handily. I would expect that I'll find a place for an India fund at some point as a trade, a longer term trade. Position trades is what I normally do. I'll own it for a while, a few years. And then EMQQ, which we've talked about over and over again, is something else that we'll want to get. I don't think it's bottomed. It might have. We'll see. Let's see if a new trend upward develops. But China probably has another knock coming because they might actually have their first natural recession in 50 years. They have a lot of retrenching to do because that real estate industry is as screwed up as ours was 15 years ago. And that's why I haven't pulled the trigger on investing in anything that's heavy in China. is one, I don't want to own the individual stocks just in case President Xi decides to hate the CEO. And I haven't wanted to buy the baskets or the funds that own partial baskets just because I think that China's got some short-term hiccups that they still have to deal with. And in the face of the dollar getting stronger, all of those global assets will get cheaper. I want to make something very clear to you. This isn't an argument. This is a fact. Every single time the dollar gets stronger, every single time, there are no exceptions in the history of the universe. Every single time the dollar gets stronger, asset prices drop. So if you're holding dollars, cash in your accounts, that money, even though you're not getting much of an interest rate, will become more valuable as the dollar gets stronger. And at some point, lower liquidity will make it harder for speculators to pump up stock prices by using calls and leverage. And that snapback won't be 5 or 10%. It'll be a legitimate bear market. Because I don't think the Fed's going to step in to prevent a 20% loss. Not this time. It's been a very long time, 13 years, since we had a loss in the stock market, the drawdown in the stock market approaching 50%. And the next drawdown will probably approach 50%, 30% for sure. Why? Because the biggest stocks, which impact the indexes the most, are the most expensive. You got 60 or 70 stocks that account for basically, and they're the big ones, that account for most of the gains in the indexes. So you have to separate out, are you an index investor or are you a stock picker? So if you're an S&P 500 investor, you might be screwed for the next 7, 8, 9, 10 years. Where the opportunities are the lower market caps, where there's actual growth. And there's a handful of exceptions among the biggies, but not many. Microsoft, I keep saying, is a beast. Amazon, though, I started to wonder, are we at peak Amazon? I think they're going to have to split off AWS to unlock some value there. They've already told you the fourth quarter they won't make any money. No profit at Amazon in the fourth quarter. But how can that be? Because it's getting so expensive for them. Transportation. We just looked at the transportation inflation. That's hard on a company like Amazon. So you need to look at the mid-cap space, small and mid-caps. Companies under $10 billion in value. We've been talking about that theme on a recurring basis for a couple of years as well, even longer. Small companies become big companies. And big companies eventually run into more regulation and competition. It has always been that way, probably will always be that way. If we get to the point where there's 20 companies in America that own everything, then they probably own you as well. So you really don't ever want that to happen. But the inflation is transitory in the short run. Very difficult to get more than 4 quarters of high inflation. And we're on quarter number 2 already. Again, just because of the year over year comparables. If oil goes from $30 a barrel to $80 a barrel, what are the odds it really doubles again? Almost zero. I've showed in a couple of articles now the chart for oil inventory. All these years, oil inventory was in here. And now they're telling us that oil inventory is low? No. In 2015, 14 and 15, OPEC flooded the market with oil. Let it start to come back down, then it popped back up because of coronavirus, and now it's coming back, or right into coronavirus, and now it's been coming back down. OPEC tried to help President Trump win by increasing inventory of oil, and now it's coming down. What's interesting is that right here, this is where President Trump was supposed to put the screws to Iran, and he didn't because he wanted oil to stay cheap because it was good for his re-election bid. Saudi Arabia got really mad at him, threatened him by pushing down inventories. It wasn't enough, but this also marks over 100 U.S. oil companies going bankrupt, 2019. The real reason oil and gas are expensive right now is because President Trump didn't put the screws to Iran like he said he was going to. He bankrupted over 100 U.S. oil and gas companies that were prepared to pick up the slack, and now they don't exist anymore. Now, I'm not saying that what President Trump did was wrong. Now, over my pay grade, whether he should or shouldn't have been putting the screws to Iran. My humble opinion, the Iranian people haven't done anything wrong, other than they didn't have enough guns to overthrow the mullahs a while back when they tried. And then all the dissidents got hung, killed, jailed. So now they have to grow a whole new generation of people who are going to try to win that country back because In my opinion, President Obama made a mistake in not supporting that revolution. We're down over 100 oil and gas companies in 2019, and I think it was 70 or 80 more that went bankrupt in 2020. And that was clearly part of coronavirus. But then OPEC and Russia cut what they were doing by 3 million barrels a day or something, and you saw inventory start to come down. But does that make any sense to you that the trader narrative is that oil inventory is low right now? Look. How can they call that low? These are different scenarios for oil demand. The very top line is an old reference scenario. And the second line, the dashed one, orange one, is actually the path we're on now. That's excluding the recent policy agreements. Presuming loose adherence to the recent policy agreements by the countries around the world, oil demand is on a plateau for a very long time. British Petroleum thinks that the lines will keep coming down, though. And they believe the peak oil demand, we're basically at it right now in the next couple, basically the rest of this decade, and that oil demand turns over by 2030. But now you have the EV tax credits that are coming back online from the new infrastructure bill and reconciliation bill. And they believe that this is probably what's going to happen. That you will have peak oil demand in the next 4, 5, 6 years. And then it'll turn over by then. The CEO of NXP Semiconductor was on Bloomberg this morning, and he made a similar point. He said, look, we're investing in all of this with the semiconductors because we know that that drives more fuel-efficient vehicles. So even if EVs don't pick up at the exponential rate like cell phones did, you still will have a lot of them sold, a lot of hybrids, and even the ICE vehicles are going to be getting much better mileage. And the miles per day driven by Americans has dropped because a quarter of the people are working at home. And this trend is picking up all over the world. Why? Well, in the emerging markets, they weren't driving anyway. Now supply chains are moving. They're not all just going to try to get to a factory. And if they do, it'll probably be on a bus. One of the companies I've been looking at is a company in the Middle East and Eastern Europe that's trying to consolidate and privatize the busing industry. So rather than just having a bus stop, you can put into your app, hey, this is where I am, what time I'll be there, add me to your route. And they run the little buses, 20, 30 person buses, which is what I think America should go to instead of having these gigantic buses that go in straight lines. Why wouldn't we just double the number of electric vehicles out there by adding a whole bunch of buses? Why wouldn't some company just buy 100,000 electric vehicles and say, hey, we're going to personalize transportation as a service? Wait, did somebody just do that? Hertz? Tesla? I think I heard something about that. All of these things are disinflationary and deflationary when it comes to transportation. More semiconductors, more electric vehicles, lowers the price of energy, right? You see that energy and transportation are completely linked with some other supply chain and labor issues attached. You're not going to see the price of energy or transportation go up much more. That'll knock the inflation rate in half all by itself. So all the people who are trying to get you hyped up on the inflation trade, they're a year late. If you've really been following me long enough to know, I have a history of being about 2 years early on stuff. But with this AI and me getting older and more experienced, been pretty damn close, within a quarter or 2 quarters on most of this stuff, giving you time to scale into the things that you need to own. These companies that I have on the plug and play lists, if you're paying attention, you've noticed some of them really start to move. Now, several of the stocks are heavily shorted, and that'll flip when it flips. But when you start seeing people on stock twits say, look, this company's got secret layoffs and employees hate the company and blah, blah, blah. And they only have 2 clients now, which are all things are verifiably not true. You have to wonder, why are you in that echo chamber? Why are you even looking at something like stock twits? Or even most of the stuff on Twitter is junk, unless you're going to a verified person that you can trust somewhat. The anonymous bloggers on Seeking Alpha are somewhat guilty of this. Not completely, but somewhat. But the social media, anonymous, echo chamber, manipulative narrative world, all I can really say to you about that is, what the fuck are you thinking? Pay attention to the people who've made a lot of money and they haven't had to talk their book to do it. They haven't had to use the media to manipulate their stocks. They just say, this is what I'm doing. This is why I'm doing it. If you want to follow along, go ahead. But if you need the echo chamber to motivate you, you should ask yourself, are you really any good at investing, and should you be handling your own money? Stop buying into the narratives, because it's what traders throw out there. It's what people who are talking their book do. I have no influence on the world. I just invest in the stuff that I want to invest in. If I could pop it up, I would show you the text. I'll probably download it and put it in an article. I just put my cousins, my brothers, my girlfriend, kids in a text chain, all 8 of them. I said, hey, this is what I'm doing with CoinBase. This is what I'm studying, and I've been studying it now since the lockdown started, so I had more time on my hands. And I've developed a pretty deep understanding of crypto and NFTs and what's coming. And I want you to click on this link that I send you from CoinBase and sign up, because they're going to give you free cryptocurrency just by studying the little lessons that literally take 5 minutes. I don't know if she's putting it in the chat, because I'm not looking at the chat yet, but Teresa's done it. You'll learn what's really going on, how incredibly impactful blockchain is going to be on the economy. And one example I would give you is that if you need to send money from here to Japan, that money will go through a number of intermediary banks, all of which are taking a fee, and usually takes till tomorrow for the money to really be there. Almost always takes a full day or 2 for the money to settle. That was the basis of a lot of the scams, right? People would say, hey, I'm going to send you this cashier's check, but I need you to deposit money into my account online real quick. But you have the cashier's check. Well, then they cancel the cashier's check, because you can actually do that. So there's new ways using blockchain technology and a number of these cryptocurrencies that will allow somebody to send money from the United States to Japan or Russia or China or Malaysia or Indonesia or India, wherever, Europe, and it will be instantaneous, usually within 5 seconds. And in the handful of transactions that require different types of verification because the product is changing hands, you can actually guarantee payment using a different type of cryptocurrency, even if the money hasn't changed hands yet, creating collateral. So what's coming through the DeFi marketplace, through cryptocurrencies and blockchain, is going to be a complete rewriting of how transactions are done, how contracts are made, anything that has to do with money or ownership or trade. It's all going to change in the next 10 years. Maybe not next year, the year after. It takes time, right? We make these mistakes with time. We think about things that are going to happen quick, and we think, oh, it's going to take a long time. Energy transition. And other things we're like, well, this is going to, take forever. It happens quick. We get our time frames mixed up all the time. It has to do with our perceptions, our biases, our politics, our religion, how tall you are, whether or not you believe in aliens, things like that. So I would encourage you to think about all these things together, because they actually do interact. Inflation, money supply, cryptocurrency, contractual and transactional nature of financial markets, ownership of real estate. All these things play in the same pool, and we don't know because we're only looking at one lily pad. So when I try to break this down to you, I want you to think through best you can what I'm thinking through. I'm an uber nerd. I get it. Think about the future. Be a futurist. It's the safest way to invest, actually, because you don't even have to be precise, right? You don't have to have everything exactly right. As long as you're going in the right direction, as long as you're accurate. See up here some of my stocks. Kinder Morgan, chopping along for years, paying out that 7% dividend, right? That's the sort of thing that you want if it has upside. It's not the sort of thing you want if it has downside. Kinder Morgan, if you watch the news, talking about building another pipeline in the Permian. Why? Well, those are the things I told you was going to drive the price of oil down, and gas in particular. They're going to start capturing all that gas at the wellhead instead of flaring it off. It's going to happen in the next 2-3 years. So be fast. MP Materials, we talked about that one when it was under $10 a share. It was still a SPAC, but I don't like SPACs. Well, think about the SPACs after the deal is announced. Don't worry about it before then. If the deal gets announced and it's a good deal, well, then figure out how to get in. Unfortunately, I've missed a lot of MP. Was able to sell some puts recently. Those are going to expire, so that's nice. I'll make that 10%, but the stock went up 40. One of the reasons I tell you to always get a starter position. Amidas, If you haven't listened to their conference call from the other day, you really should. It's a good conference call. Just listen to the question and answer from the Indian analyst who asks about the credits they're going to get from the government. Amidas is probably going to reach their 5-year goal of $1 billion of revenue. They're going to make a lot of money on the tax credits, and they're selling fuel in India now. And if you listen to the discussion about how they're disposing of carbon, you realize they're not going to get a lot of competition. They've got dairy farms all over California trying to get in on their deal. Hey, take our carbon. Give us feed for the cows. They're recycling carbon is what they're doing. They're calling it renewable. That's the in vogue word, and I'm going to yell at them for that when I finally talk to them. They should call it recycled carbon. That's what it is. It's recycled carbon. And it's amazing. So you should be selling puts on every dip. I think the stock probably comes down as the dollar gets stronger. People will say, oh, this isn't the hot thing anymore, but it's got a great long-term story. I do think it's going to triple, maybe get to 100 from here, trading at 20. But all these things they're related to the big picture, the big secular trends. I keep trying to get you involved with. Open door. There's more for them. Think about the business. Don't just say, well, they're an iBuyer. One of the iBuyers had a bad experience. Well, these guys haven't because they run it better. A lot of things come down to management. You should know that, right? You've all hated a manager at some point. You've all loved one. The success of a business is often the management. Does Warren Buffett say, invest in a business that any idiot can run because eventually one will? So keep an eye on this. Last thing I'd finish up here with, I guess 2 things. One, I have gone through the top 6 marijuana, cannabis ETFs. I'll put out that article as I piece together my notes by Tuesday. And next week, we're going to talk about those on Friday. So next week will be all about weed and why it's such an important thing. If you've ever invested in a sin stock before, an alcohol company, these weed stocks are probably going to do better than most of the alcohol companies. Think that through. The possible exception of some of the wine places. But hard liquor, beer, tell you what, man, those companies have a tough road to hoe. But the marijuana, I tell you what, that wacky tobacco, a lot of people using it. You got to realize 2 things. One, the boomers used it when they're younger, and they're using it again in retirement. Makes their knees feel better, something like that. Millennials are using it. People younger than millennials are using it because that's what young people do. And us Xers, we're small, we don't matter anyway, but, we dabble. There'll be a lot of money to be made in marijuana, and it looks like it's bottoming really close if you look at the chart. So, could it go down a little further with stronger dollar and just general market volatility? Probably. So in my stocks of the week and in the ETF articles, I'm actually going to put in limit orders for you, good till cancel limit orders that you can use. And you just let them sit. Just let those orders sit until they get hit. And be patient, because most of my prices get hit. People will say, well, price is 30% higher. It's never going to happen. And then it happens. 3 months out, 6 months out, whatever it's going to take. And then finally, the one thing I'm not going to elaborate on too much is you see these companies splitting up. General Electric is splitting up 4 years ago. I said that they had to, and now they're finally doing it. Johnson & Johnson is splitting up. Been a number of companies that have announced breaking apart lately. Historically, that has been done at market tops. It's what CEOs do and CFOs do to prepare for the next market cycle, because they're expecting this one to come to an end. And they usually jump ship to the better company. So Johnson & Johnson, for example, is breaking up into pharma and consumer goods. So the one side is going to be a consumer staple company. What do we think about consumer staple companies? They suck because they can't grow. If they happen to get loaded up with debt, they're in big trouble. If they don't have big debt, then maybe you can have yourself a choppy dividend payer, and it becomes a bond substitute, which is a very risky way to make income, but you can do it. I advocate selling options instead. Shorter term, bigger income, less risk. But hey, who wants bigger income and less risk? I don't know. I might be backwards on that. That's why I say things like I think Amazon's probably going to break off AWS at some point. And if they do, you want the AWS side, not the big grocery store side. So think through where we are in the cycle. You've got a lot of guys on Seeking Alpha and elsewhere talking about buying BDCs and other high yield stocks. They're at the point in the cycle where they can take 30 and 50% drawdowns. Any particular company, hard to know, but as a group, where we are in the cycle, where the valuations are, right? Where the valuations are, this is not favorable for chasing yield or risk. You have to find companies that on their own are down here, even though the market's up here. So being a stock picker is pretty important right now. That's why I haven't really been pushing any ETFs. This cannabis ETF is the first one in a long time. And I'm telling people to scale out of their, if you have GDX, I think the risk next year is pretty substantial. I'd be scaling out of it now. I've already sold mine. I just sold Barrett Gold. So that'll be a trade alert on Monday. So I sold Barrett Gold because, as I mused on the chat room, I just got tired of freaking waiting for it. And ultimately, relative performance matters. So if the dollar is going to get stronger, foreign assets will get cheaper. And if the S&P 500 drops, all the S&P 500 stocks get cheaper. So, and I have another fund that I want to talk to you about because it's an important fund. I think it's going to be a big fund that I use a lot of in the future. So I'll talk about that in an article coming up too. But I just want to tell you that between now and the end of the year, maybe January, you would better be to the high end of whatever your asset allocation allows for cash. If you fight it any longer, you're going to run out of time. Because when these drops come, they're going to come fast and hard. Then you'll get a little bit of a rebound, then it'll drop, and then it'll rebound, and more drop. We'll get our 3 waves down for sure. And it's going to be significant. Because when the liquidity short circuits the levered bullish trades, those trades go to zero a lot of times, right? Calls, long calls, or option margin trades, they go to zero. That's a long way down for a lot of things. You've seen how much Tesla came down in just the last week. I still say Tesla's overvalued at 400 a share. Will it ever get to 400 a share? Probably someday. Just don't know when. All right, I'll let you go after I answer a few questions. So let me take a look. Teresa saying, yeah, Coinbase, sign up. I'll put the link out tomorrow. I'll do an article tomorrow, and I'll put the link out. Somebody says Nova on PBS has a great episode on cannabis. Yeah. If you can send me that link, Julia, I'll put it in the article. I'll do a summary article tomorrow. All right. No questions about anything, really? I haven't read the WeWork S1, but we knew that they were going to raise money months ago. They're expanding, so that's good. They need money. That's good. WeWork's basically profitable at this point again. I mean, they're right on the verge. He's asking about a stock not on our list that I decided to look at. It's called Soru Capital, SSSS. And they're a good company. I've been looking at them a while, but they've gone up so much that this next cycle is going to be bad for them. So I wouldn't be buying them now, but I'd be thinking about, if they get back down into single digits, I probably want them. Most of these business development companies and private equity, kind of listed private equity, are going to have big trouble in the next year. When the dollar gets strong, asset prices go down and leverage trades get blown up. So that's just the way it is. It'll happen. This is not going to go up forever. Now, will it get all the way down here? I doubt it. But this area right in here is still a pretty substantial drop. Just to get down to fair value is this line. Between here and here is fair value. And then from here to here is undervalued. We never really get below that. I don't know that we see this again for a long time. We might not even see this again for a long time. But this area in here, it's going to happen. And with the dollar getting stronger, and the Fed reducing and the Treasury reducing liquidity, it can happen quick. I won't fart around anymore. I know people have been farting around. I know other people have been sitting too heavy in cash for a year and a half. They didn't make some of those trades that I made late last year, early this year. So be it. As Pumbaa says, put the past behind you. Or is that Timon? Timon, put the past behind you. Just wait for it to get here and have your list. DMYQ, that's Planet. It is the top company in our satellite basket. So they'll be, I don't know what the date is, but that'll soon be trading as Planet Labs. And you should own DMYQ units already. If you don't, I'd probably just buy the DMYQ stock and don't worry about the units. But all these satellite stocks are going to go up a lot. If you just watch their presentations and listen to their calls, mean, it doesn't take a whole lot of research to look at these and say they're all going to grow triple-digit rates for a while. I mean, the cloud is going to be 5 to 10 times bigger in 10 years. And most of that's going to come from satellite data and car data, cars and satellites. I mean, that's huge. And then there's other things to invest as part of that theme. But the satellites are starting from a really low number, right? I mean, how much bigger can AWS grow? Well, I guess 5 times, but it's already priced like it's going to grow 3 times. So the difference between a growth rate and a total addressable market, you have to see, okay, well, where am I actually finding the spot that has value? And these satellite as a service stocks, oh my God. And Planet Labs is the best one. Black Sky is probably second. Spire Global is probably, and Satellogic are third. And the only reason I put Black Sky above Spire Global and Satellogic is that they've already got to deal with Palantir. But all 4 of those companies, like I said, there's going to be a merger. So there's going to be a merger in there. But the whole group is going to do great. Whole group. That's why you buy all 4. Don't think you're smarter than the world and buy just one of them. Buy all 4. If you want to buy a little bit more Planet Labs than the other ones, I get it. Somebody asks, so no 30-year rate hikes with tapering. So what are the long-term expectations for growth in the market? That's where long-term rates come from, right? So if the long-term expectation on growth is 2 to 3%, why would you ever need super high long rates, right? So with the Treasury not doing as many long-term bonds, you'd think the rate would go up a lot, but it won't. Why? Because who was buying those bonds? It was the Fed. The Fed has pushed its duration out, right? Because they used to buy they used to buy short-term debt. And at the end of President Obama's terms, and then in President Trump's terms, they were buying longer-term debt. Remember when President Trump was talking about we should be buying longer-term debt because interest rates are so low? It was already happening. It was just a talking point for him. And then he said, look what I did. It was already happening. He just continued what the last guy was doing. So now in reloading the bazooka, the Fed buys fewer treasuries. The Treasury, right, issues fewer treasuries. And eventually, the Treasury by next summer wants to have even less treasuries than what the Fed was buying. And that would force interest rates up. And that's why in my tweet that I have out there just pinned to my profile, I don't think it's going to happen. I don't think the growth expectations are high enough, even with supply chains shifting and the greening of the world and everything else. It's just because that's just cannibalizing growth that we don't have anymore. It's just replacement growth. It's not growth on top of. That's why you have to avoid all those no growth, high debt stocks in the SP 500. There's nothing out there for them. They have no future. You have to invest in what's really growing, which is everything sustainable, everything smart, everything. So the sustainable, smart everything world is what you have to be invested in, because there is no demand push from inflation, from population growth anymore. And the demand push from people leaving, being poor, becoming middle class is half what it used to be. Those are important, right? There's fewer people in emerging markets that have as far up the scale to go. I mean, there's still millions, billions, but it's less, right? Because China's done pretty well, India's done pretty well. Most of Asia's getting there. So to go from having nothing to having something is the big step, right? And then going from having something to something more is a smaller step. And we know that there is a spot where most humans, and I say most, it's over 80%, just say, I'm going to screw off more and work less. Phillips curve stuff. I'm one of those weirdos that started making money late in life. I was in my 30s before I started making money, right? Most people who get rich are making money in their 20s. So I did it the other way. I raised kids, learned, made my mistakes, really started making money in my 40s. I mean, like money. In any case, the world just got less demographically driven opportunity. So you have to go to where the opportunity is, and that's the sustainable, smart everything world. And the two play together. NXP semiconductor guy talked about it. Semiconductors to bring down car pollution and increase mileage. Somebody asked about one of the satellite companies that actually produce the satellites, that build the satellites. No, I truly don't give a shit about satellite manufacturers, because eventually there's going to be 100,000 satellites up in the air, probably this decade, and then we'll stop adding them. So these little companies that are going to build some satellites and go from nothing to something, it's going to happen quick. If you want to trade them, go ahead and trade them, right? If they become a momentum trade, if you want to ride the momentum in your trader, go ahead. I mean, those opportunities are out there. But from an investment standpoint, the idea that something can 5x or 10x or 20x, not a manufacturer in the world that can do that other than Apple, and they're probably never going to do it again. Tesla, and they'll never do it again. And the only reason I'm in Ford is because they were grossly undervalued for the technology they have, and nobody assigns any value to their real estate. Do you know who's looking for some places to build cars right now? A company called Rivian. Ford happens to have an investment in them. I think Rivian is at least going to talk to Ford about, hey, can we take over 2 of your factories, right? So the cheap way, by the way, to get involved with Rivian is to have Ford stock. Ford's stake in Rivian's $10 billion right now, and I would think either they get something out of the relationship on the business side, or they sell some of that stock. We'll see. And it pays to be early because those big moves are usually early. The S-curve moves are early. You just have to bide your time sometimes. Sometimes you have to average down. But again, you know, satellite stocks are a good example. Spire Global, we started buying under 10. With the put premium, I would think that most of us have a cost basis, a net cost, not really technically cost basis, but a net cost $7 or $8, and it's 6-ish right now. If it goes to 50, are you gonna be like, oh god damn it, I could have got it at 6 instead of 8? If you are the Grinch, and I hope your heart gets warmed by something. All right, have a good day. It's another Hulk day, another museum with the Hulk. He is learning how to read at the museum. It's pretty cool, and he's learning how to speak museum words, which is, hopefully I am nerding him up appropriately. But at Christmas time, we got him some gifts that will help him with his hand-eye coordination and agility, so that next summer he and I can start doing baseball agility drills at 2.5 years old. Make this kid a third baseman. All right, take care, everybody.